Welcome all to the Node. I am Mike, aka Veteran Crypto, and this is your place for news, interviews, and DeFi education. And I'll add, no hype, no FUD, no anything. We just give facts here. We don't mess around with, crazy price predictions. We don't try to play on emotions. We just tell you exactly how it is. Sometimes that's painful to hear, but that's why we're here. Is we're here to just get into the nitty gritty, get into the facts, get into the tokenomics, and find all those little nuances that make the difference between something being a good investment and something being a higher risk. Something that that is what's the word I'm looking for?
Facts not FUD.
Yeah, facts not FUD, but basically to where it has the fundamentals, the use case, just all of the points, the checklist that you want for a solid project. And if you want to go higher up the risk profile, and you want to speculate, that's fine. But the only thing we're trying to do is educate you so that you understand that increased risk and can look at the potential reward for it. Because if you're going to take increased risk, you should be getting more reward. If you're looking for a 10x and you're going to try on a meme coin, or you're going to try on a solid project, at 10x, I would go with the solid project that has some adoption, that has something going for it. If you're going for a meme coin, I'm looking for 100, 1,000, or more, because it's a lot more risk involved. So anyway, let's pop on over here so I can add David. But before we get started, if you want to pop over to the Node.pro, well, first and foremost, you want to join the conversation. We have a lot of people that watch on X. If you want to actually join the conversation, make comments, ask questions, talk to the other people in the chat, like Jay-Z, then pop on over to the Node Network. It's at the Node Network, all one word, on YouTube. This is where you can join us and get involved with the conversation. But I wasn't even showing it. Here you go. This is what I was talking about. All right. And then also, of course, there is our official website, the node.pro. And this is where you can access our, the majority, 80% of what we offer is no catches, no gimmicks. We genuinely are looking to educate people and help onboard people into crypto safely and responsibly. And the way that we do that is we offer free education. This is something I would have killed for, 5-6 years ago when I got into crypto. This is a professionally structured with quizzes, checks on learning, where it doesn't matter if you're a beginner, intermediate, or advanced, you can go through these modules, and by the time you're done, you're going to have a firm grasp on everything from fiat currency to traditional banks and the TradFi system. You're going to understand hot and cold wallets. You're going to understand DeFi and crypto, and all the jargon that sounds like another language that you hear listening to these channels. Also, we have a community. If you want to join a great community of individuals that are, have different levels of expertise, you can come in here, ask questions, hang out, post silly shit, whatever. This is a freedom of speech. We do not censor here.
It's super cool. Cool what we're building there, and that's going to be turned into a mobile app pretty soon here.
Yep, on Android. And then this is also free. So this is our deep dive library, our Intel library. And in here, you can find, we do 10 deep dives every week. We do two, Monday through Friday. And this is where you can find them. And today we're going to be doing Plasma 1, and we're doing the long-awaited deep dive on data access.
Oh, that's going to be good. I'm looking forward to that one.
Yeah. So luckily this finished right before we went live. So I'm excited to see, kind of what it entails. But, me and David have had a lot of questions because we're very data focused. We're very fact focused. So we've been wondering, going to DeFi Llama, how and where do they pull their data? How accurate is it? Is it, can you hang your hat on it? Is it something that is reliable? So I had it pull, like CoinGlass. I had it look at DeFi Llama. I had it look at a bunch of different aggregators, and we're going to see what it came up with. But Again, all of these are here for you free to go through if you're thinking about investing in any of these. And the most important thing on all of these is if you scroll to the very bottom, is this source document. And if you scroll to the very end pages of it, that is where you will find our cited sources. This is key. When we build these are not our opinion. We don't build these out to be bullish or bearish or anything like that. We build them out with facts, and we cite our sources of where we got those facts, and they're primary sources. They're from the source documents, on the actual official website, or other primary sources, other good, solid, reliable sources. Not X posts and stuff like that. So it's so important. Trash in, trash out. Quality in, quality out. You need to arm yourself with good quality information, not hype and emotion. So, with that,
100%.
With that, David, how's it going?
Oh, Mike, blessed, man. Life is good. Life is good here on the beach, brother. I'll tell you. Wake up in the morning early and hop out to the beach, go for a swim in the ocean, and then come back, make myself some coffee, and get to work, man. So I have an entire workday before noon, which is awesome. I love that, dude. And then, after the show ends, then we run the premium live calls. And yeah, man, I mean, I'm really looking forward today to learn a little bit more about Plasma One, because I just got Plasma One on my Android. So really excited to start using that, almost like a backup to EtherFi. So that'll be interesting. But even more so than that, I'm interested to learn about all these data aggregators. Yeah. Because, DeFi Llama, as much as I like DeFi Llama, and look, I use it every single day. As much as I like it, I want to learn more about where are they getting their data from. Yeah. So that'll be interesting.
No, it will, because again, I can't stress how important it is. It's like, it's sexy to look at, numbers and charts and graphs and stuff like that. But if, the data that supplies that builds out those models is incorrect, then it's useless. And so I've been kind of curious. Is that a way that markets are manipulated? If they're because if you have the ability to tweak the information that people are getting about these markets, that you can manipulate the markets. You can make it something look like a good investment, and they invest in it while you're selling. People are FOMOing into it, while this, the big money or the people that are manipulating the market are selling into that pump. We see it all the time.
Speaking of manipulation, there's been some scuttlebutt recently on X that maybe on October 10th, BitMEX, it could have been one of the centralized exchanges that kind of blew up a little bit on the 10th. And we're seeing, just, I think it's in the last 48 hours that BitMEX is shutting down. So I don't know, do you want to run through some TA before we hop in? Or there we go, BitMEX, yeah.
Let's do TA first. Let's kind of show everybody what's going on in the markets right now, and so we can get our finger on the pulse, and then we'll get into the BitMEX news.
Sweet. Let me go ahead and share my screen here. Grab some more Kolfefe. There we go. All righty, man. So we got to start things off with Google. We have to start off with Google because, I've been reading more and more about these, these hyperscalers, right? And so, man, these hyperscalers apparently have like $2 trillion in off-balance sheet debt. And it seems like a lot of that debt is going to start to come due once a lot of these AI data centers are completed. Mm-hmm. So yeah, man, these companies are spending all of their free cash flow to build these data centers. And we're starting to see their credit spreads blow out a little bit, which is not good. So when you see credit spreads blow out, usually equity markets react after bond markets react. So if we're taking a look here just at the chart of Google, notice this level of trend line support and how Google gapped down after reporting earnings the other day, earlier this week. Google gapped down, found support at trend line support, just barely, In fact, I could redraw this level just a little bit, be a little bit more generous, I guess, with this level of trendline support. So Google sitting at a level of long-term trendline support. Now, this dates back all the way to May of last year, May of 2025. So you got to keep watching this because Google was one of the best performers earlier this year. And so, you got to take a look at the generals.
Almost all the Magnificent Seven have just been putting in. I mean, if you invested in the Magnificent Seven instead of crypto, you did much better.
Now, up until recently, yes, up until recently that was true. But these big hyperscalers, these Mag 7 items, they were referred to as the generals of the market. Mm-hmm. And so, when you see the generals get taken out to the woodshed and shot, that's when things start to roll over a little bit for the broader market.
Yeah.
So, yeah, man, Google, oh man, big gap on Google. Got to be careful. Got to be careful with Google here.
So mind the gap.
We got to mind that gap, man, because gaps tend to fill. So, if we see this gap fill, well, then, that would mean a rally up to $342 for GOOGL. Let's take a look at a handful of other items. Tesla. Dude, Tesla breaking down today. So if we zoom out here, take a look at TSLA. So it put in this is a bit of a diamond pattern. So a diamond is like a pause, a price action pattern. Okay. So this is a pause formation and then the gap down. So big gap down as Tesla reported numbers that missed estimates. So EPS, surprise to the downside, big miss for Tesla. And it traded off 14% yesterday, trading off another 2.6% today, 260 basis points. So yeah, man, Google and Tesla really breaking down. These are some of the market leaders. So when you see the leaders start to break down and you see the rally broaden, that tends to indicate that there's a top in formation. So Tesla off now 2.7%. SpaceX, oh man, SpaceX doing nothing.
I'm glad that I sold that. So I bought like just a couple, like I usually do, a couple $100 of something, and then I made a little bit of money, but just it felt like it was overpriced. That there was so much hype going into the launch that it felt like I was buying into FOMO, and so I sold it. And I'm glad I did because look at that chart.
Yeah, well, if we just kind of zoom, this is a 4-hour, so we don't have very much data here. Let me remove that little trend line there. Let's remove this, okay? And let me draw in another level of trend line resistance from the all-time highs. And look, SpaceX, this is the definition of a downtrend, right? You've got a series of lower highs and lower lows. So SpaceX doing nothing but moving lower. That makes a lot of sense, right? Because SpaceX, last year, I think $20 billion in top line revenue. How in the world does $20 billion in revenue support a 2-point-something trillion dollar valuation? Well, the market is telling us right now that it doesn't. And so SpaceX trading sharply lower, well below that IPO price of $135. So again, this is it was supposed to be a market leader. Never really did it become a market leader. So SpaceX trading sharply lower, Tesla trading sharply lower and breaking down below trendline support. Google trading sharply lower after reporting earnings, sitting at trendline support. Apple, let's see what's going on with Apple. So you see, the thing about Apple is that Apple does not have the tens of billions of dollars in AI data center spend that all these other large cap items have. So it looks like Apple is getting rewarded for not having all of that data center spend. So Apple trading sharply higher today, plus 3.6%. NVIDIA.
I actually heard a rumor. I need to look it up, but I heard a rumor that there was, I think it was Apple or somebody, Samsung, that they were going to figure out, they were trying to figure out a way to use people's cell phones to do compute, to be like a network and, somehow incentivize people to, be a part of it.
That could very well be true. I think SpaceX is planning on rolling out a service where you're going to be able to get basically cell phone service from SpaceX. Those, what's the Starlink? You're going to be able to get cell phone service from Starlink directly to your cell phone.
Yeah,
So,
you already can. I was part of the pilot for that.
wow.
It didn't work too well for me. It was just text, but that was the beta. And then yes, they're supposed to be launching to where you get full cell phone and eventually data as well.
Hey, Mike, you want to bring the chat up on the screen? A lot of people are, yeah, awesome, man. We've got a lot of engagement in the chat. Love to see that. Keep the questions coming. So, NVIDIA, man. So, I saw just an excerpt of an interview with Jensen Huang, the CEO. I think he's the CEO and chairman of NVIDIA. And, dude, in that excerpt of the interview, he was describing that circular financing logic where, okay, so get this. If I'm NVIDIA, right? And Mike, you're just a random company, right? If I give you $1 billion and then you use that $1 billion to buy chips from me, like, and then I count that on my balance sheet as earnings, is that really earnings? If I gave you the money that you then spent with me,
It's not going to give up.
Make that make sense.
I don't need to make it make sense. The rest of the world makes sense for me.
No, I'm just saying it's circular financing. It's circular financing. That's a problem.
And we can have a separate discussion on that, but the definition of revenue is what it is.
But if I gave you the money and then you spend that money with me, yeah, I can claim it as revenue. It is revenue, but it's kind of a fugazi, like.
And that's a separate conversation. My only point is the definition of revenue is what it is. That's it. We can have a separate conversation if it's a fugazi or if it's
it's a total fugazi
or something like that. But let's not get down that rabbit hole. We always end up spending 30 minutes talking about that shit.
Well, so yeah, but so this is NVIDIA here. I got to say, this is a bullish candle right here. So far on the session, we've got a bullish engulfing candle going on. The body of today's candle is engulfing the entirety of not just yesterday's candlestick body, but also the prior sessions. Mm-hmm. So, and then notice where it found resistance. So if I just go ahead and redraw this level of trendline resistance a little bit right there. So notice the gap. See the gap there? Let me just zoom in here on the daily so we can all see this gap. So you see that? The daily close on Wednesday of the Wednesday the 22nd. The daily close right there was at $212. The open for the next day's candle was lower at 210. So when the open is lower than the close on the previous session, that creates a gap. So that gap filled today, but it's also where NVIDIA found some resistance. So we got the gap fill and backed away from the gap fill. So yeah, NVIDIA definitely, I mean, look, man, it's the definition of circular financing. And that's what blew up the 2000 bubble.
Well, and that's my understanding. That's what most of these tech companies have been doing is that circular finance where they basically buy each other's products, put in orders, and it's this like fugazi loop where they loop the money to show higher earnings when in reality it really isn't, because they're not going to fill those orders.
Right, but the big problem here is that a lot of this circular financing is supported on the back of OpenAI and Anthropic spending commitments.
Yeah.
And so OpenAI and Anthropic, they've got a big problem with these Chinese models because, in China, man, they've spent 1/20th of what we've spent in the United States to build out these data centers. And they've been able to
do is build out the data centers. They probably stole the technology.
I think they did. I think they did. That's pretty clear. I mean, OpenAI and Anthropic, I think it's pretty clear that there are Chinese spies in both of those companies. They just steal IP. The Chinese are known for that.
I mean, there's a long history of that.
Yeah. So, but the problem here is that if NVIDIA is the one building all the chips. And yet all of these spending commitments by OpenAI and Anthropic, if OpenAI and Anthropic are unable to honor those spending commitments, then this entire AI trade could start to work in reverse. And so that would be a big, big problem. And I think that once you start to think about the AI trade through that lens, then the comments made by the CFO at OpenAI late last year, where she was talking about, hey, we might need a bailout from the US government, from the from taxpayers. That actually starts to make a lot of sense because they don't generate the revenues to be able to honor those spending commitments. Both of those companies have like $1 trillion plus in spending commitments. They're not going to be able to honor that stuff because they don't generate enough revenue to be able to do so. And now that you see all of these American tech companies starting to use Chinese models, it's like 60% of the token spend by American tech companies is on Chinese models now, not OpenAI and Anthropic models. So that's a big, big problem for the American frontier labs. If we take a look at
we'll go ahead and finish up really quick, but let's
yeah, I'll just run through the last three. So here's Amazon. Amazon gapping down almost in sympathy with the others in the space. Amazon reports on Thursday, July 30th. So at the end of this month, we're going to get a report from Amazon. This will be extremely important. We take a look at Meta. Meta, gappy chart. Meta gapping down here a little bit. It's got support at 563. Microsoft, this one, it's got support down here at 352. And Oracle, oh man, so Oracle is sitting at a level of long-term horizontal support. So that low right there from back in April, that was the tariff tantrum low from April of last year. That low is where Oracle is currently trading. Now, Oracle and Meta, they've got big problems because they've started to really borrow to lever up their exposure to that AI data center trade. And man, if Oracle breaks support here, then I mean, it basically enters price discovery on the downside. You could see Oracle trading for $100 in the not too distant future here. So yeah, man. And then BTC, I think that BTC probably has another couple of days to the upside. The prophecy, the Bitcoin cycle, says that in July of the Bitcoin bear market year, in the midterm year, in July, we get a rally. So July is not over. We got a couple more days left. I think that Bitcoin might actually see a rally up towards 67K. I expect that even if it breaks above 67K, that it fails up here. Now, if Bitcoin actually continues to move lower from here, then the rally's already in. The rally in July is over. And I think that we could start to think about 50 or maybe even a little bit below 50K for BTC, especially if the stock market rolls over a little bit here.
Absolutely. You're not the only one saying that. I've heard Gareth say that. I've heard Ben Cowan say that. I've heard, kind of the voices that I trust. So yeah, that's kind of what I'm waiting for. I got my dry powder on the side, and I'm waiting for some, for some sale prices, some fire sales.
October, baby, let's go. Yep. October 5th. Hell yeah.
Hey, what's up, Crypto Stevo? Good to see you, man.
What up? What up?
All right, so let's pop on over here to the news. So BitMEX announces their permanent shutdown after 11 years of operations. So the crypto derivatives exchange BitMEX has announced its permanent shutdown. Trading operations will cease on 23 September. The date falls 11 years after its founding by Arthur Hayes. If you don't know him, you probably haven't been in crypto that long. Ben Dello and Samuel Reed. The platform already halted new registrations on 23 July with immediate effect. It's a crypto derivatives exchange that made professional trading and leveraged futures contracts accessible to retail traders. Its core product is the perpetual swap with up to 100x leverage, which became an industry standard. The format today runs on thousands of trading venues. HDR Global Trading Limited has operated the exchange since its founding in 2014. Its board of directors reached the closure decision after a strategic review of the business and the wider industry. So it looks like from 26 August, risk limits take effect. The final wind down follows on 23 September with forced liquidation of open positions. The exchange's own token, BMEX, collapsed by more than 97% after the announcement.
Yeah, and it's down a further 55% today.
Well,
So
and that kind of leads me to something that you're always saying, David, is you need to be careful with these these protocol tokens. Aerodrome is one of them. I mean, like, recently they were supposed to launch this month with their new platform. Launch the new token where the merge with Velodrome. That was all supposed to be this month, and it got shifted to September. So things happen. You need to understand the risks when you're investing in these assets. Again, that is why we are here. We are going to give you, even if we're bullish on something, we're going to give you the facts and the truth about it. We're not going to sugarcoat things. We're not going to hype it up. We're not going to try to pump our bags. There's many projects that we've covered in our deep dives that have led me to sell my bags of those assets, because I got a deeper understanding of the tokenomics and the lack of value capture, or just the lack of any sort of utility for the token. Like Ondo, it's simply a governance token. It allows you to be able to vote. That's all it is.
yeah, so I think we need to coin a new term, Mike. Fugazi coin.
Yeah.
Fugazi coin. Yeah. Yeah. So look, I see traders and investors make the same cognitive error over and over again. It's a fallacy to think that just because something is down a lot, that it's a good buy. That just because something is cheap, it's a good buy. It is not. If something is off a significant percentage amount, the market is telling you that there's something wrong. Okay. So whenever you see a token like BMEX, all right, now this is maybe a unique example because they're shuttering the exchange, but BMEX off 97% the other day, and today it's off a further 55%. So just because something is cheap does not make it a good buy. And, there's solid support at zero. So I think that's where it's headed.
Well, and this is, I mean, it says that it didn't come out of nowhere. BitMEX has been looking for a buyer since February. So,
Yeah,
February
because
of
they blew
2025.
up on the 10th of October, I bet.
Well, the thing is, I mean, they have, supposedly they have published proof of reserves, and that, that they're sitting financially, fine, and according to them. But
That's got to be bullshit, though. Why would they be shuttering the exchange if they're financially solid?
and the other, well, supposedly, they just looked at the competition and looked at everything that's going on. But something that's very telling is if it's been up for sale, why didn't anybody buy it?
Because there's a problem. There's a problem there that maybe hasn't been disclosed yet.
Potentially, yeah. I mean,
Yeah.
it's it's speculative, but there is a place for speculation. If a major platform like this that was founded by big names in the industry, that's been around for 11 years, and BitMEX is not a small exchange, and for it to shutter like this, after trying to find a buyer and nobody would buy it, and they're just going to shut it down, that says something. That they're going to shut it down rather than even selling it at a discount.
So
Nobody is interested.
I'm super interested to get into that deep dive research on the data aggregators later on during the session today, during the live call today, because, look, I mean, if we had a window into BitMEX, then maybe we would have been able to see this coming. But, a lot of these exchanges, even though they might publish proof of reserves, I don't know, man, verify, don't trust. And so that's why you've got to know, where are these data aggregators getting their data from? So that's going to be really interesting today in the second half of the call.
Absolutely, absolutely. And tonight on Crypto Trenches, earlier in the chat, I don't know if you caught it, David. Somebody was asking if we could do deep dives. Let's see. It asked if we could do a deep dive on altcoin daily. And so it kind of got my, creative juices flowing. And I was like, you know what? Why don't we tonight, why don't we do a deep dive and, I'll run some information and see if we can, kind of get some data that, kind of shows which news outlets in crypto are credible and which ones have a track record of, inaccurate information or hype or, things like that. They're shilling stuff, or they're paid for their for their articles. They're paid by organizations to write certain things.
So you know what I think about, Mike, when I think about something like Cointelegraph or Altcoin Daily or CoinDesk or whatever. I think about who owns those. Like, who are the people behind those news outlets?
Yeah,
and who has a vested interest in those things. I really want to learn more about the people behind them and the businesses that own them.
I'll include that.
Yeah, because what if it turns out that Ripple Labs owns a bunch of these things?
Dude, yeah, who knows? Who knows? Is there any LPs making money these days, or do we need retail to come back before LPs are profitable again? And do you see DeFi LPs ever coming back to the levels it was 2 years ago?
Okay, so Chris,
thank you for the question.
That's a great question, and let me just take a moment to address your question. Let's bring this back up on the screen real quick. So, are there any LPs making money these days? So, in order to understand how to make money as an LP, let me just go ahead and bring this up, and let me see if I can draw this out for you guys so that we can all understand this together. So, as an LP, there are two things that you've got to understand. The first thing is gamma, okay? Gamma. The second thing is theta, okay? So gamma, that is your impermanent loss, IL. Theta, that is your fees, okay? So when you provide liquidity, be it full range liquidity or concentrated liquidity, you have significant cost of volatility. Your cost of volatility is your gamma. That is your impermanent loss. Now, when you provide liquidity, you get compensated in the form of fees. So your fees must be greater than your impermanent loss for you to be making more money than if you had just held the tokens and done nothing. So how will your fees become greater than your impermanent loss? The only way that your fees are greater than your impermanent loss is if there is significant volume in that pool. There has to be a ton of volume in that pool. Now, that is going to tell you your instantaneous P&L compared to holding. Now, you can make money in US dollar terms as an LP. You absolutely can. But if you made money in US dollar terms, but you did not outperform just holding the token, then you didn't actually profit compared to doing nothing. And so another thing that you need to take into consideration here is something called VRP, okay? VRP, variance risk premium. So when you provide liquidity, you are essentially short a put. So providing full range or concentrated liquidity is very, very similar to trading options. You are, for all intents and purposes, short a put when you provide full range or concentrated liquidity.
So the bottom line is you're looking for volume.
You're looking for a ton of volume, but I want to make one final point before we bring it back to the news here. VRP. This is the killer. Okay, so I would hazard to say that 99% of pools do not have positive variance risk premium. What in the world does that mean? Well, what it means is that the tokens in the pool are, I'm going to say, quote unquote, dumb. They're dumb. And what that means is they don't know what the price is for those same tokens external to the pool. And so what that means in practice is that the volatility in the pool for those tokens in the pool is actually lower than it is for those same tokens external to the pool. And so that means you have you don't have any edge. There is no statistical edge when you provide concentrated or full range liquidity. So the only way that you make money as an LP is if there is a shit ton of volume. If there's not, then over time, you're going to lose.
Perfect. All right. Let's see. Stevo, I wish a website like DeFi Llama showed VRP for various
Crypto Stevo, I've been building out something called Runway. So getrunway.trade is the URL. And I built into Runway a liquidity little tab there. And what the liquidity tab is going to do when I'm done building it out is it's going to scan Uniswap pools and it's going to filter for VRP. And if I had to guess, I would say that there's probably fewer than 5 pools on the entirety of Uniswap that have positive VRP. Probably 3 pools. And these are examples of the pools. It would be something like, PaxG paired with XAUT, or maybe something like, like an ETH LRT paired with ETH. Like these pools where it's basically the same tokens in the pool where they don't move against each other very much. So that means that you don't have any gamma or very, very little impermanent loss, very, very little gamma. And so that means that your theta, your fees, that actually becomes your profit. So the vast majority of your pools are not structurally profitable.
So this is a little bit old, but still very important. So a couple of days ago, when Bitcoin hit 66K for the first time, above 66K since middle of June, the rally came with 5 consecutive days of net inflows, the longest streak since early May. Over 5 sessions, funds attracted roughly $727 million. The last session alone brought in $226 million, the best since July 6th. So the total Bitcoin ETF assets surpassed 79 billion, up from about 71 billion in late June. July's gains partially offset record outflows of 2.43 billion in May and 4.5 billion in June. At the time of publication, Bitcoin trades at 66,850, up 4% on the day. We know that we've had a pullback since then, but I mean, what are you seeing, David, in the the ETF markets and kind of the correlation with the Bitcoin price, and maybe look at some charts, look at a crystal ball. What do you feel is going to happen between now and October with these ETFs?
Well, I don't have feelings.
Yeah.
I take feelings, I suppress them. I don't feel shit. Okay. Yeah. But data, I like data. Mm-hmm. And so I'm actually sharing Farside right now. And so for anyone who wants to take a look at this, it's farside.co.uk. I'm sharing the Bitcoin ETF flows. And what we can see here is that yesterday's session, we saw a $225 million outflow from the Bitcoin ETF complex. Now, that's on the back of a bunch of days here. It looks like 1, 2, 3, 4, 5, 6, 7 days of net inflows to those Bitcoin ETF products. Mm-hmm. So that's not looking all that bad. But the problem for me, Mike, is that there's a Bitcoin prophecy. Okay, I keep calling it the prophecy because that's kind of sort of what it is. And the prophecy says that the bottom's not in yet. So, we don't need to just take a look at the Bitcoin ETF flows. I mean, if we go back in time here, month to date, it looks like the Bitcoin ETF products are basically breaking even. It's what it looks like month to date. But net all time, we've seen $51 billion in net inflows to those Bitcoin ETF products. Mm-hmm. So there's definitely a demand for the Bitcoin ETF products. Now, if we take a look here at Ethereum, let's take a look at the Ethereum flows. So if we scroll down here, we've got 1, 2, 3, 4, 5 days of net positive inflows into those Ethereum ETF products. If we take a look at maybe the hyperliquid ETF products, if we go ahead and scroll down here, not a whole lot doing over here with these hyperliquid ETF products. Although, we do see $306 million in net inflows to those hyperliquid ETF products. And the last one that I'll share here is Solana. So the Solana ETF products, if we scroll down, I mean, you got 1.1 billion in net inflows to those Solana ETF products. So, yeah, I mean, are we seeing positive flows all time into those ETF products? Yes.
Steve-O's being a troll. He's like, can we look at the Cardano flows?
Oh, yeah. Well, I mean, Cardano, you talk about a Fugazi coin. I could just bring up the chart just real quick. So Cardano trading 16 cents today. And, this is what a dying project looks like. So trading well below its, let me go ahead and just grab this arrow. So trading well below its 2022 lows. So last bear, Cardano is trading well below its lows from last bear. So Gemagov here, this is an interesting comment. So he's saying that's why you borrow Bitcoin, stick it in a leveraged LP. When the price drops out of your range, you pay the BTC borrow back. So here's the problem with that. If you generated more divergence loss with the Bitcoin that you borrowed and threw into that pool, then if you had just held the Bitcoin, then you actually lost compared to doing nothing. So you got to be careful with that. Impermanent loss is real, and impermanent loss can be extremely significant. So it's a fallacy to think that you can DCA down or DCA up. You can either DCA down into an asset using an LP or DCA out of an asset using an LP. That's a fallacy, because your gamma risk, your cost of volatility, your impermanent loss, if you're not earning enough fees to beat your divergence, then you are losing compared to doing nothing. So you got to be really, really careful with those LPs. Oh my God, Jeff, no, never. I'm not grabbing arrow. What are you talking about, man?
Really quick, Crypto Steve-O says, which is worse, impermanent loss or holding Cardano?
I mean, they're both doo-doo. But if you understand impermanent loss,
at least with impermanent loss, you'll still end up with something.
Well, I mean, Cardano's got solid support at zero. It's trading 16 cents, but I think zero is a pretty solid level for Cardano.
All right. Well, let's pop into this bit of news here. So the Genius Act in 2026. So institutions that choose to lead will shape the architecture of what's next in the payments era. Those that partner will need to move with precision and speed. So when Congress enacted the Guiding and Establishing National Innovation for U.S. Stablecoins Act, or the Genius Act, it did more than establish the first federal framework for payment stablecoins. It signaled a structural shift in the U.S. financial infrastructure, moving digital asset payments from the periphery of experimentation to the center of regulatory and strategic focus. By 2026, that shift becomes operationally unavoidable for banks as rulemaking is accelerated. Competitive boundaries are being redrawn, and the decisions institutions make now will determine their relevance in the next generation of payments. So let's skip ahead. The rulemaking process, where the Act implementation stands in 2026. So the Act's one-year implementation deadline was driven in an usually accelerated regulatory cycle, pushing federal banking agencies from conceptual frameworks to fully formed rule proposals in record time. By early 2026, the regulatory perimeter for payment stablecoins is no longer theoretical, as agencies are constructing a prudential regime designed to prevent runs, protect consumers, and impose transparency on the market that has historically operated outside traditional oversight. As these rulemakings advance in parallel, the industry is building and defining moment. The Act is not merely a compliance mandate, it is a foundation of new payments architecture in which digital dollars are expected to operate with the same safety, stability, and supervisory discipline as established financial instruments.
That's bullshit.
I don't think that traditional has safety, stability. We can look at inflation. They're not stable. So
you see what Gemagov is saying in the chat? So, brother, listen, it doesn't matter who you're getting that information from, okay? I was a professional LP for 5 years, and I can tell you that doesn't matter if you enter 50-50, it doesn't matter what type of complex mechanics you try to execute as an LP, impermanent loss is real, okay? Impermanent loss is real. And if you're making less as an LP compared to holding, or losing more as an LP compared to holding, then what are you doing? You're taking on a ton more risk for less reward or
think
greater losses.
what confuses him, because it confused me at the beginning, and it confuses a lot of people, is the illusion, because when you enter that pool at 50-50 and it starts kind of DCAing, it starts selling, say it's a BTC USDC, and it starts selling that USDC into Bitcoin. It's like, yeah, it looks like, that you ended up with more Bitcoin, as it reaches the bottom of that range. But what David's saying is that if you just held on to that Bitcoin, when it goes
the USDC,
down,
the Bitcoin and the USDC,
that it ends up to where you would have been better off basically to do nothing. It's like, yeah, you end up with
exactly
more Bitcoin,
right.
but because you're DCAing, say that, just for a round number, say it's like 50,000, as it's going down and it's hitting 49,000, 48,000, whatever your range is, and it's DCAing you out, you're incrementally buying Bitcoin. And if you stay in the pool, potentially, minus fees and stuff like that, when it comes back up, if you never exit and make that impermanent loss permanent, potentially, it would do the same thing on the way back up. It would, sell that Bitcoin back into
USDC.
50-50.
So here's the thing. If you lose more as a result of being an LP compared to holding, or if you make less as an LP compared to holding, then what you actually did is you took a ton of risk on for no reward.
Yeah.
So if you enter an LP, I'm the one who taught you this. Yeah, man, look, I've learned. And so Gemagov, I thank you for mentioning that in the chat, man. So after November, when Gemini 3 came out, I was able to, because I'm an options trader. And so, liquidity provision is an option. It's a derivative. So what I was unable to prove prior to Gemini 3 was that I really started to think in October and November of last year that I was the yield as an LP. I came up with all sorts of different complex strategies to try to mitigate impermanent loss. There is no way to mitigate impermanent loss. It is structural. Dude, in liquidity provision.
I couldn't figure out how to track it. Because I was building spreadsheets. Those that have been watching, DeFi, crypto, and airdrops, like when me and Jeff first started that, I got these, Excel spreadsheets that had all the formulas and stuff. And so I was tracking, how much liquidity I put into a pool. I was tracking over time, what the total value of the pool was, and trying to extrapolate, if I was making money or losing money. I was looking, to try to build, like when AI first came out. I remember sitting in my brother Taylor's law office on a computer, and I was trying to use doesn't matter what it was, but I was trying to figure out how to build an app that would do it. But this was very early on, and my knowledge was very limited. And so it is such a complex thing, and a lot of these protocols and a lot of content creators. And I applaud David for admitting it's like we all learn, we all grow. I can't count how many bad calls I've made in crypto so far. That's why we always stress here. We don't have a crystal ball. We don't know everything. We're learning as much, if not more, than a lot of you. From all the research that we do to do these shows. We're all learning. And
so Mike, can you bring the chat back up, please? I want to just address Gemagov real quick, because he's saying that I was the one who taught him this, and I taught a lot of people how to provide concentrated liquidity, and I was wrong. I was wrong about liquidity provision. It is not structurally profitable. It simply is not. The only way that you can get to profitability compared to holding as an LP is if there is a ton of volume in that pool.
Crispy, he's like, he made the same spreadsheet that I did, and he followed along, and 8 out of 10 were negative, 1 neutral, and 1 positive.
And you see what YB?
I only had 1 pool that really, well, two pools that really worked out for me that that I can name off the top of my head.
And why did they work? They worked
Well, it
because
was
of volume.
USDC because of high freaking volume. It was like the largest volume pool on Aerodrome, and then the other one was Plume, and it was because I was earning like a couple of 1,000%
Right.
But
Exactly.
as soon as it dropped off, and the price started tanking, it just started eating all my profits. But thankfully, I was harvesting that yield and investing in other things.
So, and what YB374 is saying is he's saying, can't we avoid impermanent loss if we enter an LP by doing a snuggle entry? I came up with the snuggle entry.
I was going to say, I know exactly where they came up with that term snuggle.
So actually, it wasn't me. It was what the hell? He was my first client, my first ever private client. He coined that term, the snuggle
rebalance.
Well, the snuggle entry or the snuggle rebalance. And so the problem, you guys, is that impermanent loss is structural. And the only way that an impermanent loss is your gamma, that's your cost of volatility. The only way that you can beat IL is if there is a ton of volume in that pool. That is the only way. So, and then it looks like, Demagog, you're saying, it's no different than if I borrow Bitcoin, sell it, wait for the price to drop, then pay the BTC borrow back just in an LP with fees? No. Unfortunately, Demagog, that's not true. So when you provide liquidity, you're going to face that cost of volatility. You're going to incur divergence loss. It doesn't matter if the price goes up or the price goes down. You're going to incur divergence loss. So most of the time, you're better off just holding the assets and not providing concentrated liquidity.
Jeff, did those assets give you consent to snuggle? It was non-consensual snuggling, Jeff.
Yeah, so I mean, I think that a lot of people, and myself included, up until last November, don't understand impermanent loss. Like, we really need to understand gamma. We need to understand impermanent loss. We need to understand cost of volatility. The only way that you can beat that is with a ton of volume. And you can try to hedge, by, getting short the underlying moving volatile asset in the pool using like a perp stacks. But when you do that, when you hedge an LP or a CLP, what that forces you to do on the way up is realize your divergence loss. So you don't want to do that. And then, a lot of people will lever liquidity pools, maybe on a protocol like DeFi Tuna. And when you lever your exposure to a CLP, all you're doing is magnifying your gamma. And if your gamma is greater than your theta, meaning if your impermanent loss, if your cost of volatility is greater than your theta, those are the fees that you're earning, then you are not profitable compared to holding. So yeah, I would be really, really careful providing concentrated liquidity or full range liquidity during a bear market. The only time it really works is when there is a ton of volume in a pool and when the assets move sideways in the pool. That's when it really works. But if the assets aren't moving sideways and there's not a ton of volume, then you're not going to be profitable compared to doing nothing, compared to just holding.
All right, so I'll put a final point on this Genius Act implementation and the bank lobby threat. So the core conflict with the July regulatory rulemaking deadline arriving, traditional banking lobbies, including the ABA and the OCC, are aggressively pushing regulators to enforce strict capital rules and ban yields on stablecoins. The yield loophole. Banks are demanding that regulators prohibit non-bank stablecoin issuers from passing interest or yield to users, fearing a drain on traditional bank deposit bases. The industry pushback. The Blockchain Association and DeFi advocates warn that these restrictive interpretations threaten consumer choice, stifling competition and forcing centralized banking models into decentralized rails. And I would tend to agree. I think that banks have shown that, one, they can't be trusted. Two, they are predatory, and three, I think that no bank is too big to fail. They've been very loose and fast with the liquidity that we put in the banks, and multiple times they've had to be bailed out with our tax dollars. They weren't charged interest. Anytime that we borrow, we have to pay them interest. They can borrow our money out multiple times. For every dollar that we deposit, with fractional reserve current lending, they can lend it out up to 40 times. And I think that the banks have failed, and they've controlled and owned our government for far too long. So I think it's about time that whole model goes away, personally.
Yeah, well, it doesn't seem as though it's going to go away anytime soon. And, with this Genius Act, it looks like USDC, USDT, Tether and Circles products, they're being regulated into becoming CBDCs. So whenever I, read this language in these acts, and they're talking about, oh, we want to protect consumers. And it's like, bullshit. They want KYC AML so they can track everything you do with your money so they can steal from you. That's the point of all this legislation.
Well,
I don't think
it's all about power and money, and control. If everyone is keeps using the banks, the banks keep making all the money. Politicians know, how do you think that all these politicians end up, with tens of millions, if not hundreds of millions of dollars of, in wealth, when they're making, $200,000 or so in, a salary?
Yeah, they're trading.
Yeah,
they're trading. Yeah.
Well, they're trading and they're getting legal bribes. They have all kinds of legal ways that they funnel money to these politicians to do their bidding.
So Crypto Sivo is saying in the chat that crypto has drifted so far away from its original concept. Bitcoin hasn't. Bitcoin hasn't. Bitcoin is still the only decentralized commodity. It's the only one. Maybe you could say that Monero kind of sort of is, because it's got a very decentralized validator set. But hey, man, the moment that we see covenants on the Bitcoin layer 1, that will open the door to true DeFi on Bitcoin layer 1. When we get true DeFi on Bitcoin layer 1, I think it's BIP 360 is the proposal for enabling either OPCAT or covenants on the layer 1 on Bitcoin. The moment that we see that, we're going to have developers, myself included, building DeFi protocols on Bitcoin's layer 1. And what that means is we're going to start to get true decentralized finance products denominated in Satoshis, not in US dollars. So I'm looking forward to that. And he's saying, why not use a layer 2 like Stacks? So Stacks has kind of a sordid history. And the big DEX on Stacks, I think it's called Alex, it was hacked to the tune of like $200 million within the last 12 months, I think. So, and the problem with the layer 2s on Bitcoin is that they don't accrue value to the layer 1 at all, because everything happens off chain. So if you're talking about Lightning or Stacks, or there's a handful of them now, all of those layer 2s, they all transact off chain.
Well, because like you said, they don't have covenants or smart contracts.
Well, so they do. The layer 2s have like
the layer
smart contracts,
but I mean the mainnet doesn't have
right. The mainnet doesn't have smart contracts, and so you've got to ask yourself, over the next 6 years, when we have 2 more Bitcoin halving cycles, and 6 years from now, after that next, so we got another Bitcoin halving cycle, and then after the second Bitcoin halving cycle, the next one in 6 years, those block rewards are going to drop to below 1 BTC. So miners need transaction volume at that point in time for them to be incentivized to keep their machines on. So we've got to see covenants on the layer 1. We've got to see smart contracts on Bitcoin. We've got to see Bitcoin native DeFi for there to be enough transaction volume for miners to be incentivized to keep their machines on.
That's why I brought this up. And that's the key, Joe. Is that without if Bitcoin mainnet isn't able to start generating some sort of revenue, fees and revenue. This is what we talk about in the trifecta, and why Bitcoin, when we ran our deep dive research on it, failed horribly when it comes to the trifecta. Is it's not sustainable with the halvings. I mean, we've already seen, major Bitcoin mining, companies switching over to AI because it's more
Yeah.
profitable. And
Yeah.
so if you get this mass exodus of people not mining Bitcoin, the network becomes less secure. So there
Yeah.
needs to be a way to incentivize these people to, secure the network. And really, DeFi is the only way that I can think of right now to do that.
And so I think what Gemagov and Crypto Stevo are, maybe let me just put this kindly. It's a mistake to think that covenants are bloat. They are not. Inscriptions are bloat, but covenants are not bloat. So, you know what might be valuable for everyone and for all of us, Mike, is some deep dive research on Bitcoin covenants so that we can all start to understand this. So maybe we could do a deep dive research on OPCAT and on covenants, because covenants are not bloat. Inscriptions are bloat. BRC20s are bloat. Covenants are not.
Cool. All right. Well, before we start the deep dives, if you could, please smash the like. We try to give really good information here, and we don't do advertisements. We don't have sponsors. We don't have affiliate codes. We don't do any of that, and we do that so that the information that we give is unbiased. So if you could, it's free to you. If you could just hit the like button, subscribe if you enjoy the content, and share it out. Help us grow the channel and help onboard people responsibly to these investments, these assets, and so that they can get a good solid knowledge, because there's so many pitfalls, and that's our mission here, is to educate people in a responsible way and help them navigate and avoid a lot of the mistakes that we all made when we got into these markets. So
Yeah.
please like, subscribe, and share.
Yeah. Facts, not FUD. All righty. So, and if you guys don't mind, jump into the chat at the node.pro. Hop into the community. It's free, man. If you want to ask questions of me or Mike or anyone, hop into the community. It's all free in here, man. We talk about all the deep dive research. Speaking of deep dive research, let's hop into that. It's the second half of the call. So, and today, you guys, so this is going to be generated automatically. The AI that I built into this takes all of those pieces of deep dive research that we run every single week, 10 pieces of deep dive research, and it creates the weekly Intel overview. So this is from last week at 5 p.m. Eastern today. The AI at the node.pro is going to generate the synthesis of all of the pieces of deep dive research from the previous week. So that's going to post in 4 hours time today. Now, today what we're going to do is we're going to run through Plasma 1 and we're going to learn about data aggregators. So I want to start off here with Plasma 1. And for anyone who's interested in going through this piece of deep dive research and then sharing it to the source room, you can do that here within the Intel library. Now, Mike, it looks like we're missing the video content for Plasma 1. Maybe that was an error on my part. I think that, no, there's the video overview.
Data. I'll take a look.
Yeah, let's run through the data aggregators then as you upload the video content to the node.pro. So data aggregators. So which ones are we taking a look at here? And I'm going to go ahead and share this to the source room. And I'm just going to let everyone know we are talking through data aggregators now live. Enter. There you go. So anyone who's in the community, anyone who's in the source room can now just hop in here and take a look at the data aggregators. So here we go. Let's learn a little bit about data aggregators in crypto and DeFi.
When you pull up a crypto dashboard, those glowing green numbers feel like objective truth. You assume you're looking at a reliable reflection of the market. But if you look closely, that single interface is actually blending hard mathematics with unregulated wash trading and unverified claims submitted directly by project founders. Data platforms split into two paths: on-chain extraction and off-chain harvesting. On-chain queries ledgers directly, pulling from archive nodes to mathematically verify every transaction. Off-chain relies on centralized APIs, meaning you trust unregulated corporate entities when they report their own volumes.
Oh man, that's dangerous. So I would much, much rather rely on on-chain data rather than off-chain data.
We evaluated these pipelines using a 4-part rubric: their methodology transparency, their data verification, their source independence, and infrastructure uptime. This quantifies exactly how much data is verifiable and how much is based on trust. Relying on any single default dashboard guarantees you have massive blind spots.
Okay, so one thing here, trust in crypto and DeFi? Nah, can't do that. It's got to be verify, don't trust.
To get an accurate read on the market, you have to unbundle your analytics. Take Decentralized Finance. Platforms like DeFi Llama excel at mapping complex smart contract interactions to track a network's total value locked, or TVL. We see a structural problem here: the DeFi multiplier. Watch the capital flow. An investor deposits 10 baseline Ethereum into a staking protocol. They take that receipt, lend it to borrow a stablecoin, then drop that stablecoin into an exchange. The exact same capital is counted multiple times, turning 10 ETH into 25 ETH of reported TVL.
Uh-oh.
During market peaks, the global multiplier hits 2. Half of all reported TVL is this derivative double counting illusion. DeFi Llama solves this by building a specific toggle directly into their dashboard. When you switch it on, their backend actively filters out the downstream protocols that merely allocate existing assets. If you fail to filter out those double-counted metrics, you are risking your capital based on a massively inflated view of a protocol's true economic size. If you move away from on-chain data to off-chain aggregators like CoinMarketCap and CoinGecko, the risks change entirely. These platforms harvest real-time price feeds from hundreds of centralized exchanges. The massive structural vulnerability is raw volume. Research suggests 50 to 70 fabricated volume
Uh-oh.
creates a false signal of market interest, luring traders into illiquid assets. When those traders try to exit, the phantom liquidity often vanishes, leaving them trapped. This reliance on raw reported volume is why retail traders are the primary victims of off-chain manipulation. Then there is the derivatives layer. Platforms like CoinGlass rely exclusively on centralized exchange APIs to map market leverage and liquidation zones. Under calm market conditions, this direct connection works perfectly. The APIs provide a steady stream of data to build flawless, real-time leverage heat maps. But the October 2025 crypto crash exposed the catastrophic data failure that occurs during high volatility events. As this diagram shows, major exchanges intentionally throttled their public APIs to protect their own internal servers. They capped outward reporting to just 1 notification per second. While $14 billion in actual liquidations were happening, the restricted APIs reported only $2.4 billion. Aggregators process the streams they are given. Relying exclusively on centralized API data for leverage tracking guarantees you will fly completely blind at the exact moment the market crashes. Institutional-grade tools like Token Terminal and Glassnode avoid these API issues by processing raw ledger updates through their own proprietary archive notes. They translate those raw blockchain records into traditional TradFi metrics, mapping out entity cohort flows or calculating price-to-sales ratios for specific protocols. But pulling directly from the ledger has a critical flaw. These systems do not inherently filter out cheap, automated Sybil transactions. On modern networks where transaction fees are fractions of a cent, automated spam can artificially hyperinflate active user metrics and transaction counts.
So what protocol do we see that on a lot? I think that up until maybe recently, we saw that on Solana a lot.
Treating crypto protocols exactly like traditional corporate equities fails completely if the analyst doesn't manually adjust for cheap on-chain spam. By aggregating the scores across our 4 metrics, transparency, verification, independence, and uptime, we've produced a final 100-point audit. Open source on-chain tools consistently outperformed opaque off-chain systems. Financial survival in this market requires matching the specific aggregator architecture directly to your exact strategy. For the DeFi workflow, use DeFi Llama to track yields and stablecoins, with the strict warning to manually toggle off double counting. For fundamental value investing, use Token Terminal to map protocol revenues, but firmly discount their active user metrics on low-fee chains.
Right.
For macro analysis, rely on Glassnode to track long-term institutional capital flows for Bitcoin and Ethereum. For token discovery, use CoinGecko for safe price tracking, trusting their multidimensional score to bypass wash trading. Finally, as mapped on this decision tree, Leverage workflows belong on CoinGlass for mapping liquidations in calm periods, with the urgent warning to abandon the tool entirely during extreme market panics. The smartest investors never search for a single dashboard of truth. Instead, they constantly cross-reference centralized claims against mathematically verified on-chain reality.
All right. So
That was hugely valuable. I kind of wonder if, using that, if we could find a way to pull those individual, data streams, for each of those, kind of uses, into one dashboard, to where, you're not using any one of them, you're using a group of them for all the different data points.
I think that we definitely could do something like that. No doubt about it. So we've
Well,
got a
and Steve, we'll go over to DeFi Llama and see if we can find that toggle that they were talking about.
So here's what I want to do. I want to play this last bit one more time.
Transparency, verification, independence, and uptime.
Okay, so DeFi Llama, token terminal, coin market cap, coin glass. Okay, so I've got all of those pulled up. So here is coin glass. Let's see here. That's coin glass. Here's token terminal, right? Here's coin gecko. Yeah, they've got a free API. And here's DeFi Llama. They also have a free API. So whenever I'm using DeFi Llama, let me see if I can bring up Canton, because this is, I think, a good example.
Well,
So if we take
this like dumbfounded us for a minute. I remember me and you going over this, and we were like $209,000. We know that there's more TVL than that, and so we started digging, and this is what really started us thinking about doing this deep dive. Is we finally found out it doesn't include RWAs. So understanding that that RWAs aren't included in the TVL, that changes a lot. So
yeah, well, I mean, RWAs are the TVL on Canton.
Yeah, I mean that's where other than $209,000, I mean around $400 billion is on currently on Canton, but it's all
per
RWA.
month. Yeah, per month that's settled in repo volume. Yeah.
No, it's more than it's actual 400 billion in TVL, and then when it comes to like the actual transaction volume, it's in the trillions.
Yeah, so I mean, this is just a good example of what to look out for when using data aggregators like DeFi Llama. Now, if we take a look over here at CoinGecko, the thing that I really like about CoinGecko is their free API. So you can either use this free, you can just basically get a free API key here, or if you're building in Cursor, it can just pull data from CoinGecko into your app without needing the free API key. I recommend that you grab a free API key if you're going to build with this.
The video said that CoinGecko and CoinMarketCap were the best for prices.
Yep, that's what it said. Now, if we take a look over here at CoinGlass, so this one, a lot of people like to use this for the liquidation heat map.
Well, what was the data that the deep dive was saying was the most, that CoinGlass was the most reliable for?
I think that they were referring to the liquidation heat map, the liquidation levels, because it pulls in data from all of these centralized exchanges to see where there are liquidation levels on the way up or on the way down.
Gotcha.
So here, let me just sign in. Let me sign in to CoinGlass real quick so we can take a look at that liquidation.
Well, while you do that, Steve-O, you're saying that you need to take notes. Yeah, no, exactly. But that's the beauty. That's why we we came up with the Intel library. So you can go through this deep dive as many times as you want, take as many notes as you want, do as much research as you want. We have the cited sources so that you can, dig down, as deep as you want. So no need to take notes. Obviously do whatever you want, but it's there for you if you want it.
Yeah, so these data are actually very valuable. So if you want to take a look at the liquidation heat map for Bitcoin or for Ethereum, I think the best place to do that has got to be CoinGecko. Now, what I'm looking for, or this is, CoinGlass. So what I'm looking for here is there's a liquidation map here. I wonder which one it is. Liquidation levels, liquidation map. I'm looking for that famous liquidation map here it is. Perfect. Okay, so this is on a daily. Now, sometimes it's more valuable to zoom out to a yearly. And what I'm looking for here is how much liquidity, levered liquidity, is piled up above or below the current market price for a particular asset. So if we're taking a look at BTC, right, and we're trying to figure out, is there more liquidity piled up above or below? This is the place to do it. So CoinGlass, this liquidation map here. So take a look at this. It looks to me as though above the current market price, you've got, it looks like $3 billion in cumulative short liquidation leverage. Now, if we take a look and see, okay, how much leverage, how much liquidity is piled up below? How much long liquidation leverage is there below the current market price? $2.5 billion. Now, this is over a yearly time frame. So, and then if we get closer to the current spot price of BTC, it looks like you've got a couple of levels on the downside where you could see significant long liquidations. But notice this big level of liquidity piled up above. This is short liquidation leverage above. So there is, 100x leverage. There's about $250 million, 100x levered above the current market price.
So let me decrypt this a little bit for the wider audience. So basically what David's saying is, and do you mind popping over to the other heat map? It's a little easier for people to understand, the one that has like the shaded, levels. And
so that would be this
yeah.
one.
So basically what David's talking about, this kind of, is a little easier to understand, but you can see, the candle chart. And the price, that's the price of Bitcoin moving. The yellow is where liquidity is piled up, longs and shorts. And if you watch this, you can see that a lot of the market makers and a lot of the people that manipulate the markets, they hunt that liquidity because that's how they make money. And so what they'll do is they'll pump the price or dump the price to try to liquidate those people so that they can basically gobble up that liquidity. So that's what David was talking about is, with that liquidity piling up, is depending on how juicy that liquidity is, then they'll go hunting for it.
Yeah, so I like to call that a winter mute special because
they're famous.
They're famous for that. Yeah. So, just above the current spot price for BTC, we see that there are, it looks like a couple 9 figures of liquidity piled up above the current market price, all the way up to 65K for BTC. You've also got some levered longs below the current market price for BTC, but the amount of liquidity below is lesser than the amount of liquidity above. So what does that tell you? It tells you that it might be more likely that we see short liquidations, meaning we see some type of a squeeze up.
Yeah. A pump in price to liquidate those shorts.
That's what I'm thinking. And then if we bring it back to the chart of BTC over here and we zoom in on this daily chart. So when I see Bitcoin pulling back from that level right there, that high that was put in, this is an immediate term high that was put in the middle of June. That high comes in at, let's call it $67,300. Bitcoin pulled back from that level before touching that level. So this is a lower high, but this move back to the downside, it's still within this immediate term uptrend for BTC in July of the Bitcoin bear market year. July of the Bitcoin bear market year is usually, seasonally speaking, a bullish month. So the month is not out. It's July 24th. And so that tells me that with all that short leverage up above the current market price, could we see one final push to the upside to liquidate all of those leveraged shorts before we see Bitcoin eventually roll back over and make a move down towards 50K? I certainly think that that's likely. So using a tool like CoinGlass's, So using a tool like CoinGlass's liquidation heat map, it gives you a window into levered longs and levered short positions
Not a
on.
guarantee, but potential moves.
Yeah, it gives you a window into that. And so, a lot of people like this liquidation heat map. I prefer this one. There we go. I prefer this liquidation map. So you can see here, this is just on the daily. You can see that it looks as though there is significantly more levered shorts above the current spot price for BTC than there are levered longs below the current spot price for BTC. That simply tells me that I think it's more likely that we see another push to the upside before eventually I think we roll over.
Twinklebell's asking, you know that chart that has all the red and green months, like historically, like which months have been red and which have been green. Where can he's wondering where he can find the information.
That's a good question. So I know it's on one of these data aggregators.
Oh yeah.
I'm not sure which one.
I'll look for that. Keep going with the other data aggregators. Because I really want to get to DeFi Llama and that toggle, because that I've never heard of that before.
Yeah, so DeFi Llama, that toggle that it was talking about, I've never used that before. So let's see if we can find it. If I head on over here to chains, and then if I scroll down here a little ways, let's see if there is a column where I can deduplicate data. Maybe it's done by default. I don't know if it is or not. And sometimes these pieces of deep dive research can hallucinate. That's definitely a possibility. It could be just inaccurate data there. I don't know. But TVL range, columns, names, protocol, DeFi TVL, 1 day, 7 day, 1 month TVL change, bridge TVL, stables, market cap. So I don't see where you can deduplicate data like that. It would make sense to me that it would be done by default. Let's click into one chain. Yeah, I would think that it's done by default. Let's just see here. So scrolling down, okay, columns. Here we go. And this is for Ethereum. This is for all Ethereum chains. So I'm looking at the columns tab here, and just scrolling down, I'm looking for some type of deduplication toggle.
This is what I was able to find. To filter out duplicate data on DeFi Llama, look for the double count toggle. DeFi Llama refers to duplication as removing double counted assets, tokens. Okay, so go to DeFi Llama, look at the left sidebar, or click on the settings menu icon if you're on a smaller screen. Locate the Include in TVL section. Uncheck or toggle off double count.
Okay, so I'm looking for settings.
It says look on the left sidebar or click on the settings menu icon. Locate the Include in TVL section.
Okay, where is the settings menu? I don't know where that is, Mike.
Well, just look in the sidebar.
There it is. See that? I found it.
Oh, there you go.
Yeah, so it says Include in TVL double count.
Yep.
So include TVL protocols which TVL feeds into another protocol. Okay, so let's see if I click this, let's see what it does to Ethereum. So here's Ethereum's TVL and DeFi sitting at roughly $41 billion. And then let me just scroll down so that we've got a basis for comparison. So if we're taking a look at Lido or Aave, let's use Aave. So $11.73 billion in DeFi TVL. I'm going to go ahead and scroll up. I'm going to click on double count. And what does only do? Okay, so I just clicked double count. Look at that. It did. It doubled it up, man. Almost. Wow. So now if I scroll down, let's see which protocols are most affected. So it didn't actually change the TVL on the protocol level. So Aave's TVL unchanged when I clicked double count. Okay, so that's kind of interesting, but it did double up the DeFi TVL for Ethereum. So I've got include in TVL double counted. Let's see what this does to another chain like Solana. So if I hop on in here and I click on double count, okay, but it didn't double up the TVL. Probably because Solana doesn't have a bunch of layer twos. Let's see what happens for Tron. Double counted, 4.81. Remove the double count, no change at all. So my guess here is that because there are no layer 2s on Tron and no layer 2s on Solana, that means that when you double count, it really doesn't change the figure all that much. Let's take a look at the base chain. 4.54 billion in DeFi TVL. If I click double count, it damn near doubles it up. Wow.
Yeah.
Okay. How about Robinhood chain? That's a new one. And this is double counted TVL. Let's remove that. Okay, so it really didn't change it all that much. That's kind of interesting. How about SUI? So my guess on SUI would be that this figure wouldn't change all that much because there aren't any layer 2s there. Double count? It did a little bit, Okay, let's turn off the double count. And how about AVAX, Avalanche? 400 million. And let's click double count. It doubled it. Wow. Huh. So this must mean that, if I, let's say I take AVAX, I deposit that on a money market, I borrow against it, and then I use what I borrowed, swap it into AVAX, and take that AVAX and supply it on a different money market on AVAX, that would get double counted here. Now, if I figure out...
And I want to emphasize what the video was talking about is, that potentially inflates what is the perceived available liquidity is. And so what it was saying is that if you're going off of this data and it's doubled up, that potentially you would enter into something, you would think that there's deeper liquidity so that, that you'd be able to exit. But whenever you go to exit, there might not be the liquidity to exit.
Right. And so we've seen chains become deprecated. A lot of chains have gone bye-bye over the last 12 months, and it's accelerated year to date. Now, a good example of that from this past bull market is the Phantom chain, which became deprecated and rebranded into Sonic. So I was working with a private client who had 2 BTC on Phantom, and he was asking me to help him exit that 2 BTC position. So when we were looking at his wallet on the Phantom chain, those 2 BTC, and this was back when Bitcoin was hovering around 100K. So with Bitcoin at 100K, his 2 BTC position, his wallet was showing him that that 2 BTC position was worth $200,000. But unfortunately, there was insufficient liquidity for him to be able to exit that BTC position on Phantom for stablecoins. So if there's insufficient liquidity to be able to exit, then you're going to take a huge haircut when you go to exit the position. And so he was lucky that he was able to get 10 cents on the dollar for that 2 BTC position. So rather than getting 200K for those 2 BTC, he was able to get 20K. And he was lucky to be able to get that 20K because that chain became deprecated. So yeah, you've got to track liquidity. If there is insufficient liquidity to be able to exit, you're stuck holding a bag of doo-doo, and you don't want to get wrecked that way.
And I have a little story where I opened my Coinbase wallet one day, and it said I had like $3 billion, and I'm like, what in the hell is going on here? And very quickly I figured out somebody airdropped me some bullshit meme coin that supposedly had some huge valuation. So before I messed with it, I went and did some research, and basically on my wallet I had a couple $1 billion, but there was no liquidity. And if you went and tried to pull the liquidity out, there was an exploit to where basically they would be able to access your wallet. If you went through and clicked and tried to cash that out, then it would give them permissions to basically drain liquidity out of your wallet. So
yeah, you see what Crispy's saying in the chat? Avoid Phantom wallet. So it's not the Phantom wallet. Phantom was a very popular chain 2 bull markets ago,
and they rebranded this and called it Sonic.
Yeah, so they deprecated the Phantom chain and rebranded, created a new chain called Sonic. Now, a good example of a chain with insufficient liquidity is Cardano. So let's just take a look real quick over at Coin Market Cap so that we can get a little bit of data into Cardano's total market cap, right? So let's take a look here. Cardano, it's number 16 by market cap right now, roughly $6 billion market cap for Cardano. Let's say that you're holding an 8-figure bag of ADA, right? Let's say that you've got a ton of ADA. You've got a $10 million ADA position. How the hell are you going to be able to exit that position? The answer is you can't. Now, especially not in Cardano native DeFi. So let's just use that as an example. Let's say that you've got a $10 million ADA position and you hop on over here to DeFi Llama and you take a look at these Cardano native money markets like Liquid, right? If you take a look here at Liquid, this is a Cardano native money market. And then we take a look at the actual protocol itself, okay? So again, this is a huge red flag. Just seeing this right off the bat, huge red flag. But if I've got a $10 million ADA position natively on the Cardano chain, and I want to be able to exit that position or borrow against that ADA position, that ADA spot position,
The liquidity
it doesn't exist. So if I'm taking a look at stablecoins here, you've got, let's see here. So if there is a tote for USDM, if there's $1.5 million of total supply and 840K is borrowed against it, that means that there's roughly 700K available in this market on Liquid to be able to borrow.
Say you had 800K or $1 million in there and tried to pull it out.
Well, if you've got, let's say, a $10 million ADA position, you don't even need to have that much. Let's say that you've got a $1 million ADA position and you come in here and you think, oh, you know what? I'll be able to borrow USDM or USDCX against my ADA. You can't do it because what you're going to end up doing is if you borrow USDM against your ADA here, number one, you're going to be paying 21% to borrow. But the moment that you borrow, if you try to borrow at a 50% LTV in this market, you're going to push the borrow APR up against yourself because you're going to take that utilization in this market and you're going to push it way up towards 100%. So you might end up getting stuck paying like 70%. I think it would be much higher than that.
Oh, okay.
But if like USDCX, so this is a Cardano native stablecoin, I believe. So there's only like 200K of liquidity in this market to be able to borrow. And if you borrow, you're going to pay 7.41% right now. But if you borrow all of the available liquidity here, then you're stuck, man. You're going to push the utilization rate in this market all the way up towards 100%. And you're not going to be able to exit that ADA position by borrowing. So you've got to check out the liquidity on these protocol native money markets. Otherwise, you might get stuck, man. So this is something that you've got to look out for. If there is insufficient liquidity on any chain, then you can't operate on that chain. So Cardano is just a great example of a chain with insufficient liquidity. But there's a lot of them, man. Like if you scroll down here and take a look at some of these chains, like once you get down towards like Stacks or Rootstock, I think that these are both Bitcoin layer 2s. If you take a look at Katana, I think that this is an EVM layer 2. Cardano, of course, insufficient liquidity. Aptos, like Aptos somehow got included in that SEC Sweet 16 list. I don't know how, but yeah, insufficient liquidity on Aptos. You scroll down here, Bear chain. Man, who wants to be on a chain named after bears? I want to be on the bull chain, not the bear chain. You take a look at something like Pulse chain, insufficient liquidity. So I think what we're going to see here over time is I think we're going to see a lot of these chains go bye-bye. I think that we're going to see a lot of these chains cease to exist because liquidity flows to where it is treated best, and liquidity flows to where there is deep liquidity. So if you're holding assets on these crappy chains, you might want to reconsider that position simply because there's insufficient liquidity here to be able to do anything in size. So yeah, be careful. Alrighty, let's bring it on back here to the Intel library. I want to take a look at that deep dive research on Plasma One because I really, really like EtherFi. And Plasma One is a neobank competitor to to EtherFi. So I'm going to go ahead and share this in the source room, and I'm just going to say we are rolling through this piece of deep dive research on Plasma 1 right now. Join the chat. There we go. So for anyone who wants to hop into the community tab, this is all free. Let's hop into the Intel library and let's learn a little bit about Plasma 1. Before we do though, let's just take a look at the chart of XPL, just real quick. That's the native coin for the Plasma chain. And so this is a daily. I want to just go ahead and zoom out here. And ouch, yuck, Plasma, XPL, this thing, nothing but down and to the right. Okay, so with that as context, let's bring it back to the deep dive research and let's learn about Plasma.
Digital fiat currencies, primarily stablecoins pegged to the US dollar, have secured unquestionable product market fit. In emerging markets, they serve as a critical mechanism for hedging against local currency inflation and executing cross-border remittances. Yet deploying these assets for everyday consumer spending introduces intense user friction. A user attempting to buy a cup of coffee with a stablecoin must typically navigate fragmented self-custody wallets, acquire completely separate volatile tokens just to pay for network gas, and route funds across highly complex cross-chain bridges. Legacy payment networks like Visa process thousands of transactions a second without requiring the consumer to understand the underlying settlement rails. To achieve that exact level of frictionless utility, the complexity of cryptographic execution must be entirely abstracted away from the end user. This 3D diagram shows the architecture of the Plasma ecosystem, a vertically integrated protocol designed specifically to resolve this friction. At the base is the Plasma Layer 1 blockchain, an execution environment optimized purely for stablecoins.
So I got to say, just real quick, Plasma, the Plasma chain, it was one of my favorite chains to operate on because there were some really exciting interest rate arbitrage opportunities over there using PTs, Pendle PTs. And the chain itself is extremely fast and very, very cheap. So it was a pleasure to be able to operate on the Plasma chain.
Sitting directly on top of it is Plasma 1, a consumer neobank application. Enveloping both is the native token economy, governed by the XPL asset. By controlling the entire vertical stack, from base layer consensus to the final mobile interface, the protocol scales digital dollar transactions to global point-of-sale systems without exposing consumers to the cryptographic mechanics occurring in the background. To understand how the ecosystem functions, we must start at the execution environment, the Plasma Layer 1. The majority of top-tier blockchains are built as general-purpose computing platforms, processing everything from decentralized exchanges to complex gaming smart contracts. Plasma strips away that generalized overhead. Its infrastructure is engineered exclusively to maximize stablecoin payment throughput. This comparison table outlines the architecture separating Plasma from standard chains. The engine is Plasma BFT, utilizing the fast hot stuff protocol. Paired with a RETH execution layer, this produces 1-second block times and throughput exceeding 1,000 transactions per second. These metrics are not arbitrary targets. Legacy point-of-sale terminals require immediate transaction authorization. Sub-second deterministic finality ensures that merchant checkout confirmations occur on-chain within standard consumer expectations. High-speed isolated proof-of-stake chains carry a low-documented vulnerability. Because their validator sets are relatively small, they are susceptible to deep state reorganizations, where an attacker rewrites the ledger history. This flow visualization maps Plasma's security countermeasure, periodic Bitcoin checkpointing. The network continually takes its high-speed state routes and permanently writes them directly onto the Bitcoin ledger. By hard-coding its history into Bitcoin, any attacker attempting to reorganize the Plasma ledger would be forced to simultaneously rewrite Bitcoin's proof-of-work hash rate. The protocol decouples high-speed execution from settlement security. The result is a network capable of retail-grade transaction latency, fortified by nation-state-grade immutability. An optimized execution layer requires liquid assets, meaning digital dollars must be securely onboarded into the Plasma environment. Traditional Layer 1 blockchains rely on wrapped asset bridge pools. Users lock original assets in a smart contract on one chain and mint synthetic equivalents on another. This design fractures global liquidity and creates massive, concentrated capital honeypots that are routinely targeted and violently exploited by malicious hackers. Plasma circumvents bridge vulnerabilities entirely by utilizing native integration with Tether's USDT0 standard. This schematic details how USDT0 operates directly at the protocol level. It leverages Layer 0's Omni-Chain Fungible Token, or OFT standard. The standard enables seamless one-to-one cross-chain transfers. Users moving capital do not lock funds in third-party pools. The asset transmits across layers, bypassing exploitable smart contracts. This integration allowed the network to launch with immediate deep liquidity, accumulating over $2 billion in stablecoin volume on its first operational day. Preventing liquidity fragmentation at the protocol level ensures that users interacting with the consumer-facing application never experience the friction of slippage, capacity limits, or delayed bridging times. The base layer sets the parameters for what is possible. The actual consumer adoption occurs one layer up, at the Plasma One neobank interface. Onboarding is non-custodial, structured through a partnership with Privy. Users generate on-device cryptographic key pairs using email, social logins, or passkeys, completely bypassing the cognitive barrier of seed phrase management. Because Plasma is not a licensed depository institution, stablecoin balances are not treated as bank deposits and carry no government insurance. The user retains absolute cryptographic sovereignty over their funds, preventing any third party from moving capital without their device-level authorization. To spend these balances, Plasma integrates with Bridge and Rain under a Visa Principal Member license. A user's stablecoin balance can be deployed instantly via Apple Pay or physical cards at merchants across 200 countries, bypassing traditional regional card restrictions and heavy foreign exchange markups. When capital is not actively being spent, users can direct their idle balances into the platform's Earn Vault. This vault connects directly to the Aave v3 dynamic lending market, deployed natively on the Layer 1 protocol.
So this is what I'm super interested in learning more about, because I've seen advertised on the Plasma One neobank APRs on your stablecoin balances of, at one point it was like 10%. I don't think it's 10% any longer. But even if it's 6 or 7%, imagine being able to earn 6 or 7% on your checking account balance. That is pretty cool.
The yield generated from this lending demand is calculated continuously. A user's digital dollar balance earns interest on-chain up until the exact fraction of a second a retail card transaction is authorized at the terminal. Users can also send these stablecoins globally in seconds. Peer-to-peer transfers utilize Plasma's proprietary routing network to execute zero-fee global remittances, aggressively undercutting legacy wire and transfer services.
I thought that XRP was going to do that, Mike. What the hell?
you just gotta wait. It's the partnerships are being suppressed because they don't want to tip their hand that what's coming.
Oh, that's right. Yeah, so it'll happen tomorrow.
The generational wealth, the generational
That's
wealth.
right. But doesn't it mean $10,000 XRP?
Oh, of course, of course.
The application repackages the raw utility of decentralized finance, global spending, dynamic yield, and instant remittances into a recognizable standard account framework, shielding the end user from the mechanics of the blockchain processing underneath. The Plasma ecosystem presents an inherent economic paradox. If the primary utility of the network requires consumers to transact entirely in stablecoins, how does the native XPL protocol token, which possesses a hard cap of 10 billion units, accrue and capture value? This cyclical flowchart maps the network's modified base fee burn mechanism. While Plasma uses an EIP 1559 style model, it employs a protocol-level custom paymaster, meaning users literally pay their network gas fees in stablecoins. When that stablecoin fee hits the network, a programmatic sequence takes over. The protocol executes an automated background market swap, using the stablecoin to purchase and permanently burn the equivalent $XPL.
Okay, so you see this little piece of math right here? So this is in the source documentation. And this
it's so easy to figure out. I mean, look at it. I mean, it's carry the 2, multiply by 5.
Hey, look over there. It's a working.
Hey,
don't worry about it. Don't worry about it.
Even a monkey could do this. Hey,
yeah, that's right.
This equation models the net change in circulating supply. The integral function here tracks transaction volume multiplied by the current token price. The math establishes a strict correlation. As consumer transaction velocity accelerates within the neobank, the deflationary burn rate of the $XPL token forcibly increases. The variable labeled L in that equation represents the secondary value sink, mandatory supply lockups driven by the multi-tier membership system of the Plasma One application.
So that's actually pretty cool because if you lock up, I think it's like 20,000 XPL, you get a greater cashback on every transaction. I think you can get up to 4 or maybe 5% cash back, but I think that you might have to lock up like 200,000 XPL to get that.
Jeff wants us to take a look at the governance.
Look at the governance.
Just, we want to make sure that all the value is captured.
Oh, and Scotty D is saying PEMDAS, parentheses, exponents, multiplication, division, addition, subtraction. PEMDAS.
To access premium consumer benefits, such as elevated cashback rates, VIP travel concierge services, and automated coverage for AI subscriptions like ChatGPT and Claude, users must lock between 20,000 and 100,000 XPL tokens in smart contracts for a minimum of 12 months. Further supply is absorbed by the consensus layer. The protocol offers a decaying 5% annual emission rate to incentivize staking. To encourage high retail participation, Plasma implements soft slashing. If a validator experiences downtime, the system penalizes reward eligibility for that period, rather than confiscating the principal of the delegator. These mechanics operate collectively as a consumer utility sink. Every new retail user acquired and every stablecoin coffee purchased is programmatically converted into structural scarcity for the active liquid XPL float. While the programmatic scarcity mechanics are rigorous, the entire network faces a severe macroeconomic stress test. The Genesis distribution allocated specific token volumes to early investors and core contributors. These allocations are subject to a strict one-year lockup cliff, which concludes abruptly on September 25, 2026. This chart visualizes the scale of the impending unlock. Approximately 1.76 billion XPL tokens will transition from illiquid lockups and enter the liquid float. That volume represents roughly 63.2% of the total released supply, hitting the market on a single day.
Oh man, that's no good. So here's the thing. If there is, and it looks like there is, a programmatic, maybe not a burn, but a programmatic destruction, I guess, of XPL tokens, that's great. But on the 25th of this year, on September 25th of this year, if we're going to get a 63% increase in the total supply of XPL, I think that could explain why the XPL token has done nothing but go down and to the right. So yeah, this is something to be on the lookout for.
As early funding rounds gain the legal ability to realize their returns, this structural supply expansion will introduce immense immediate sell pressure into the market. The system's design of Plasma and XPL creates a highly efficient engine for stablecoin utility and token deflation. The ultimate test of that architecture relies entirely on whether the neobank's consumer adoption and the resulting fee burns and utility lockups can scale fast enough to absorb the incoming liquidity shock.
Oh man, it looks like it might not be able to do that this year. So if we take a look over here at the chart of XPL one more time, I mean, ouch. Yeah. So I think what's going on here is we're seeing that even though there is some type of a programmatic buyback and burn, it's not enough to keep up with the inflation of the token. So we see that a lot in these different protocols that we review during the deep dive research here. So, another example of that is Canton. As much as I love Canton, like this thing is still inflationary. And, the token trading.
Call it like it is here. It's we're very bullish on Canton Network and, what they're doing and the potential, but facts are facts. It is still inflationary. The buybacks and burns, the fees, fee burns, not buybacks and burns, the fee burns aren't keeping up, with the inflation of the supply.
Yeah. And what I want to continue to watch is the daily burn mint ratio. So as of yesterday, it was sitting at 0.65. As of today, sitting at 0.74. So if we see this move up towards 1.0, I would expect that that would translate into number go up for the token. But as of right now, it is still inflationary. So yeah, just something to keep in mind that when you see buyback and burn models, as long as the token is deflationary, that buyback and burn model should accrue value to token holders. But the token needs to be deflationary, and we're just not seeing that yet for a lot of protocols.
Yeah. So I'm getting blown up on X, with all my comments that I'm setting people straight on Kita. I
Oh,
want to
good.
watch this because supposedly they're implementing a some sort of buyback and burn mechanism, and because I've seen a bunch of talk about the revolver and a lot of the anchors and how they're going to have to pay a fee, as far as those anchors. But everything that I've read, like most projects, it's being hyped up. But everything that I've read is those fees are going to be so small that it's really not going to have a major effect on being deflationary for the token. But let's see. This is what they posted. This is an official post from Kita. Let's see what they say about it.
To open its ecosystem to third-party anchor providers. Qualified fintechs, banks, and developers can now list their anchors on the Globetrot Resolver, Kita's main resolver. Their services are now discoverable by default across official Kita products. Previously, only Globetrot-operated services were listed. Anchors power financial services like bank deposits, foreign exchange, stablecoin bridges, tokenized assets, and lending. Providers set their own fees and access requirements, creating new revenue opportunities while expanding the network. Resolver fees help acquire and permanently burn KTA, linking ecosystem growth to the token. Every listed anchor undergoes compliance review and ongoing oversight, providing a trusted environment for users and institutions. Your anchor, connected to the world.
So, what is the fee? And like I said, I mean, and don't get me wrong, a lot of the stuff that Kita is building is sexy as shit. Like their app. I mean, I was very impressed with that, and a lot of these services that they're building out, very impressed with it. The major disconnect and issue that I have with this project is one, how it's the same critique that I give for Aerodrome, which is my largest holding, is the lack of transparency. When it comes to the new tokenomics, the new functionality of the protocol that's launching. Same thing with Kita. It's their documentation and the way that they the transparency that they have for a lot of the functionality. Like this supposedly there's this buyback and burn that's being implemented. Okay, what is the fee structure? What is that going to look like for burning the token? Is it going to be like a fraction of a KTA token, or is it going to be a substantial amount to where it's going to dramatically decrease the circulating supply of Kita, potentially by making less Kita, if it's necessary in the ecosystem for utility, to have an anchor or to to operate on the network, then that would make that the need for the token in the ecosystem and there being less of it would potentially drive the price up. But it really depends. I mean, the same thing with XRP. The gas that you have to pay is so minuscule that was like the whole selling point, is it was cheap gas fees because compared to Ethereum, is that it was faster and it was cheaper. That was the big selling point. But at max TPS, I've said it over and over again, it's like 5,000 years that it would take to burn 10% of the supply. So it's really important. It's like, yes, okay, they're implementing a buyback and burn, but what is that, the details of that? So
I think Kita is bullshit. That's what I think.
And it's too early on a lot of these projects just to make a blanket statement like that. But I do see issues, and the issue is transparency. If you're going for institutions, if you're trying to be a reputable, credible, project, you need to be transparent. You need to show the details of the tokenomics. If there's going to be a buyback and burn, what are the details of that? And I haven't been able to find anything. I mean, you can click on this and it should take you to the documents, but does it say anything? Let me do Control F and let me look at fees. Nothing.
And Mike, you want to share that screen there?
Yeah, I was just kind of looking at it myself, but I can share it. So, I mean, this is, their official website, and it's talking about, what that video was just talking about.
So, Mike, the only thing that I need to know about Kita is that I saw, some video content of the CEO flexing a gold Rolex. And it's like, bro, like that in and of itself is a huge red flag.
Well, stuff like that reminds me of the Hex founder. You know, that guy that was out buying Louis Vuitton and all that all the time. That's what the creeps that it gives me. But so I mean, it says here to support the operation of the revolver and its compliance program, Globetrot will charge a small basis point fee payable in KTA on FX and asset movement anchor volume, along with a monthly compliance fee for participating providers. Under Globetrot's operating policy, a portion of the fee revenue generated through the revolver will be used to acquire. So it's not even the whole fee; it's a portion of that small fee. So that's even worse.
Yeah, this is a Fugazi chain. This is a Fugazi coin, and we ran deep dive research on it, and I don't see any value here at all. It's going after the same vertical that so many other chains and protocols are going after. I think that we're going to see winner take most. So Kita is not going to be one of the winners here, I don't think. Not at all.
Again, it's too early to tell on a lot of these. I sold my Kita. After we did the deep dive and the more I looked into it, especially, after the community came after us, I really started digging into it because that's how I am. If you come after me and attack and try to say that the information that we're giving out is bad, it's the same thing that I do with David. Whenever he talks about Arrow, it forces me to dig in deeper and to become more knowledgeable so that I can speak from a place of knowledge and not say, well, I think and I feel. I can say, this is the data. And that's how we all should be, is, whenever you hear us say things that are FUD, it should make you dig in. It should make you be like, oh, you know what? I'm going to fact check that asshole and see if he's right. And
yeah, facts, not FUD.
Yeah, we expect you to come and tell us. If we're wrong, freaking come at us. Cite a source, give us the cited source of how we're wrong. Me and David both will wholly admit that we were wrong, and we'll change our information. We're not perfect. We know that we're going to get things wrong from time to time, but finding one small thing wrong does not negate the whole deep dive. It doesn't negate everything that we say. It just means that we got one part of it wrong. So
I don't think that we've gotten anything wrong when it comes to Kita. I think that Kita is a Fugazi chain, and I don't see any adoption. I don't see anything to get excited about. When I take a look at the KTA token, it looks like crap. And so here's the thing. When you see down only for a coin, that should tell you something. And what it tells you is that the market is telling you that there's something wrong. Yeah.
Well, just that there's no interest. If there isn't, volatility, if it's just, I mean, it's a slow dying of, it's just a slow capitulation. And so if there isn't people buying dips and, trying to build bags, and there isn't, institutions, and, there should be an up and down, even if it's going down, there should still be some up and down, and then, maybe it recovers and makes like a cup and handle. And, there should be some, some fucking juking and jiving in the chart.
Another thing that's a big problem for me when it comes to Kita is that I get Richard Hart vibes from the founder.
Yeah.
Like, that is a huge red flag, man. Like, whenever you see a big red flag from the team members, especially from the founder, when you get big red flags from the founder, you got to heed that warning, man.
Yeah.
So, yeah, I would stay far, far away from Kita.
Well, we're out of time, and yeah, Steve. I mean, that's kind of why I started looking into Kita while David was talking, because I actually saw Crux's post, and and he was, I'll actually show it real quick.
Richard Hart, Twinkle Bell, is the guy who founded Hex, the Hex chain.
Yeah, it's an old project that died. It was basically he was extracting liquidity to fund his lavish lifestyle, and so yeah, this is the post that I saw. And Crux is a good dude. I mean, he actually a lot of his content I've enjoyed, but it's very geared for engagement. I'll put it that way. So this one here, it's a confirmed buyback and burn model. That's very misleading, because yes, there is a buy and burn model, but it's very, very important to frame that properly, and I haven't watched the video yet, so I'm not gonna go too deep into that. I want to see what he actually says about it, because he's usually pretty good about detailing it, but you need to understand the nuances, and it's hard with a project like Kita, because they are very opaque when it comes to the details of these things. I've listened to a bunch of the spaces, the X spaces with Ty, the CEO, and it's he makes a lot of claims and says a lot of words, but doesn't say a lot. And so be very careful. That's all I'll say.
Yeah, I would say that if you're making content about XRP and XLM and Kita, and it's the same type of shill type content, like, it's not a good look. It's really not a good look.
Be really careful of any project that there is a ton of hype and not a whole lot of substance. I pointed it out the other day. Somebody was trying to, basically like kind of shill Canton. They were trying to put out, like basically, unsubstantiated claims. And I told him, I was like, brother, don't do that. It doesn't need it. It has plenty going on with it, that just reporting the news on it is enough. You don't need to make up stuff. It's so important that we try to make sure that we're not just reposting things because they're bullish. We really need to look and make sure the information that we're sharing is as accurate as possible. So anyway,
hell yeah,
that's all I got. You got anything to close out with?
Well, if you guys get value from this, hop into the chat over at thenode.pro, jump into the community. The best way that you can support us on YouTube, like, share, subscribe to the channel. But if you get value from what it is that we do, we give just about everything away for free. If you want to support us, we've got a couple of different premium tiers of the Node.pro. Think about maybe supporting us that way. We're going to have today at 5 p.m. EST, we're going to have a new synthesis week in review of all of our deep dive research. One post every Friday, 5 p.m. Eastern Standard Time. It's a premium post. All of the deep dive research that we produce on a weekly basis synthesized into one post. So if you take away nothing from the week, then just hop into that one piece of deep dive content, and that will be enough for you. So
that's our live show, Crypto Trenches. It's a reboot of Crypto and Chill. So me, David, and Jeff will be on, and we're going to be talking about what David just talked about, and I'm going to put together some content on some of the major crypto media outlets, and see if we can peel back and see which ones are giving good information and which ones are paid shills. So I'm going to see what I can find out for tonight.
It's going to be good.
Awesome. Well, we appreciate you all, and until next time, Veteran Crypto out.
Peace.